Right, let's get going then. So this theme keeps coming into my head. I've found and swiped shamelessly a quote from Einstein. Everything must be made simple, and I firmly believe that some of the simplest concepts, the simplest ideas that simply work should be simple. And all the best ideas are ironically simple. I've known far too many people over the years that make this trading thing complex. And the only time I actually worked in the industry, at my first job 21 years ago, was for a black box software company. And the owner was the absolute um, effigy of making it too complicated. He was a PhD mathematician, very smart guy, had a system. Ironically, it worked, and he never followed his own system. It was a real eye opener to watch someone create something and then never use it. And I've learned that lesson personally a few times over the years, where you think you're smarter than your own system. And the reality is we're not. What I'll demonstrate to you in just a moment is the simplicity of what we're doing. It is not complex, but it clearly works. And we don't need to inject our own viewpoints into it. Anyway, it looks like everyone's here. So ahoy there and welcome. If you are looking for something to swing trade the markets with, then that's what we're going to look at today. As I was just ruminating over, trading should be simple and it should work. That's what I'm going to show you today. My aim with these sessions, and the longer I'm doing this, I try and give as much away as I can in these open sessions. And if you want to work more formally with me, you can. But again, I try and be as open and transparent as possible where appropriate with the limited time that we have. My objective is to give you the right tools, the correct rules, the software to assist you, a community to support you, and a mentor to show you the right way so that you can actually get real results fast in the smartest possible way. What I'm going to do today is break down my number one. I'm actually going to break down two of them today, of the rules to my strategy, production line trading. It's a simple rule-based system. It's proven profitable, repeatable. It takes 20 to 30 minutes a day, a few times a week. And this is one of those dials that you can turn. You can speed things up or you can slow things down. If you've got less time, turn the dial down. If you've got more time and you want to be more actively engaged in the markets, then turn the dial up the other way. It makes no difference. For me personally, I want to crank the dial the other way. I want to spend as little time as possible doing this without sacrificing the profitability. I found my sweet spot is what I'm trying to get to with the same system that you can apply from day trading all the way through to investing. I want to get paid at the end of the 30, 60, 90-day sprints, essentially. And I want to be doing it with as little screen time as possible to get the active engagement in the markets, but without the time commitments and not sacrificing that profitability that we're talking about. One of the core principles that I use and have used all my career, and everything is pretty much based around this, is buy the dip. It's such a silly thing, but what most people don't understand is what the fucking dip means. And it grinds my axe. And all we need to do is add a qualifier, an uptrend. Buy a dip in an uptrend. If you just do that, if I was to drop dead today, find an uptrend and then just buy the next dip. I'm going to show you how I qualify that, and more specifically, how we're going to find a dip worth buying. And it's not just me saying that it works. It's not my viewpoint. It's not my opinion. It's backed by data, backed by science, backed by numbers. We can plug the rules that I'm about to explain to you into software. And there's many of them available at varying price points. I use a middle of the range to upper end of the range software called TradeStation. You can use TrendSpider if you're not a coder. You can use TradingView, which is essentially the same platform. If you are a coder, you can program these things. You can hire people. I'm not a programmer. I hire someone. But the point is, if you go to something like TrendSpider, you can go if this, then that, and it's a system builder in basic language. And the point of mentioning it to you is we've all got the tools available to test ideas. Is this going to make me money? Because the worst thing that we can all do is go, I think this will make money, then go and do it. And it doesn't. We get to test ideas in historical data. and you just to validate the concept, because there's plenty of strategies that I know that they're just not right for every market condition. One of the things that I was talking about with my private trader group on Monday was, on Wednesday, was just that. Some strategies, they're great ideas, but you can't trade them all the time. What I'm looking for is a bread and butter strategy, something that I can apply consistently, methodically, all those words, on a regular basis, because that's what I want. That means that I can get consistency, and I should be able to emulate this performance that you see on the chart there. That's one of the back testing reports. We'll look at lots of those hopefully today. Well, we will look at them, several of them later today. If you've got any stocks that you want me to review, I can plug any stocks that you're looking into. As long as it's listed on the US markets, I just have US data. If you want to look at futures, you want to look at stocks, you want to look at commodities, I've got most of the data that's listed on the US market. So if you want to plug it in and just say, is this style of trading worth it for any of the stocks that you're looking at, let me know. If you've got some trades or some stocks that you've been looking at that's kicked you in the shins, let me know. Let's plug it into the algorithm and see if we can find a trading opportunity that you may have not previously discovered. Anyway, it looks like we're all here. I think everyone's here. Hello, Eddie. We've got a few new names. Mark, Neil, obviously welcome. Zeke, hello. Zeke, you're late. 100 lines, please, Zeke. Right, so if you are new to these sessions, the agenda is I'm going to talk at you for about 60 minutes. If you want to talk with me, pop a comment in the chat box. I'm going to spend 2 minutes just introducing myself to the noobs. We're going to look at the markets. I'm going to show you the rules that I use. And I'm also going to look at the bottom. Everyone's looking at bottoms at the moment, cheeky little bottoms. If anything, I amuse myself. that's all it is. Everything's to amuse me. The fact that it may get a chuckle out of you is also a bonus. Anyway, pinching bottoms. We all like to look at them, but we need to know if there really is a bottom there or not. So we'll look at like some of the hallmarks of how we can determine that for ourselves. Again, it's not complex what we do. All we're looking for is kind of like, remember that game Spot the Difference? You had two pictures, and there was a completed picture on the left and a partially completed picture on the right, and you get to spot the bits that are missing in the partially completed picture, spot the difference, and you'd circle them. That's kind of like what we're going to do on the charts. We're going to look at the partially completed picture right now in real time, and then just look back in history to see if there's something similar. And we can get clues. It leaves a footprint. History leaves us lots of clues to be able to evaluate these things. So we'll look at some of the things that I do. It's really simple. It's not complex. You can apply it straight away, and that's what we'll get into. As I mentioned just before we started, you can work more closely with me. I'll give as much away as possible in the short time that we have together. If you want to speed up your development, you want to speed up your learning curve, getting a mentor is the fastest way. What I do is not right for everyone. I fully appreciate that. There's lots of styles of trading. If you like the sound of it, you want to talk, we'll chat. If not, I'll always point you off in the right direction. And what I do, I know it works. Again, it's not just me saying it. My students get results. They tell me that they get results. Even when the market is crashing, we're getting results. Okay, we're not quite a crash, a very speedy sell-off on the last 7 to 10 days. So we're making money on a regular basis in up and down markets is the point. Now, the way to get, press no wrong button. There we go. Way to get the most value out of today's session is to comment, like, interact, share, ask questions. If you're watching this on the replay, like, comment, share. If you're watching this right now with me, pop a comment, ask questions. So before we get into the charts, as usual, quick warning, I'm not diamond handing. I'm not going to the moon. I follow rules as I suggested. It took me a long time to get here, but it shouldn't take you a long time to follow along. Rules are boring. Rules work. Rules stop me from being a zombie trader, sitting at the charts for hours and hours and hours, flicking through chart after chart after chart, trying to find a trade that may or may not work. What we don't want to do is ever be asking ourselves, where is the trade? If you're sitting at the charts for 2-3 hours at a time, analyzing one chart, drawing trend lines, adding indicators, the Dow theory, the GAN theory, the Elliott wave theory, the bullshit theory, the alligator lines, the zigzag tip top, whatever the fuck's going on in your life indicator, then you're doing, something's wrong. Something has gone wrong. What we want to be able to do is go, there it is right there. There's the trade. That's what we want to do as traders. There it is. Now, the catch to this is it requires patience. You've got to wait for the setup. We've got to be like a farmer. We've got to plant our seeds and wait for the crop to grow. And that's what rules allow me to do. It's bloody boring, just like a farmer waiting for the crop to grow, but it works. I'm going to demonstrate that to you right now. It makes money. It makes me money. Of course, I get my own results. And what I'm going to show to you is how you can get your results. These are just some of the recent trades we've placed. Some of you have seen these slides before. I've pulled my finger out and added some new ones. There we go. There's my cue to say, here's the new ones. Don't tell anyone, it's a secret. SPY is what we looked at, is a more recent trade. We talked about this before the move happened. The last couple of weeks, we've been saying sell the rallies. I took a week off last week, but while I was on vacation, staycation, local holiday, mini break, whatever you want to call it, I was basically flamingo spotting in lion country. I like going to zoos. I like traveling. I like, as I mentioned, spending as little time as possible at the computer. It doesn't stop me from placing trades when you know the rules. You've got a screenshot of my broker statements, the percentages you can multiply up or divide down, whether it's $50, $1,000, $500, $5,000, whatever. The percentage return on capital is what you're looking at, and then you can insert your state into that location. It's not the only one. It's not a one-off. I've got to admit, I did buy a little bit of a lottery ticket, so the percentage return's a little bit inflated. I would normally buy slightly longer dated options with at the money. This was an out the money option with a short date expiration because I expected a short-term trade. I can show you exactly how we find these. This one was a little bit of off-piste just with the setup, but nonetheless, it does follow strict rules. It's not an isolated incident. I finally got a new personal best. Again, I didn't know that this was going to be the one. But nonetheless, 1,418% return on capital. I only closed it because it was expiring this month. So that's the only reason why. I was running out of time. I use options or stock options as an alternative to stock. And again, the point I'm trying to get to more than anything is that it's consistent. And just in the interest of disclosure, I've not yet got the slides on there. Yesterday, I closed several break-even trades. There was a couple of 2, 3, 4, 5%ers. There was a few 10, 15, 20% losses. Just because I was closing and tidying up my energy sector stocks. So again, they're not all winners. It's just obviously we want to shout from the rooftops that the winners far outshadow the losses. Now, when you do have losses, you may be tempted with any system, not just my system, but with any system. And I was reading about various biases that we all have recently. And one of them is... not confirmation bias. What's the other one? Sample bias. That was it. You may be tempted to think that a strategy or a system doesn't work. And I fell prey to this very early on in my career. And I would trade something. What I've noticed with most traders is whatever system that they're using, they'll watch a system in real time to see if it works. You obviously want to kind of paper trade it and validate it, see if it works on with a very small sample set. And you have this holy shit moment. It works. And then the very next trade that you place, having watched the system for days, weeks, maybe even months, is that's the one that's going to lose your money. And then you think, this is bullshit. It's a scam. It doesn't work. The broker's out to get me. The vendor's an idiot. Oh, it's all a scam. It's not. It's just there are peaks and troughs in every system. And you've probably just watched the winning cycle. And then what happens is you end up trading the losing cycle of a system, and they all have them. So the hard part is staying consistent. I'm going to show you some ways to actually overcome that later, but it's probably not broken, the system that you're using. You've just not got enough of a sample set of data to see that, oh, it goes in cycles. There's going to be winning phases. There's going to be losing phases. And if we just like put it into contrast with, say, the real world of business for it, again, we're all smart people here. Even if you don't own a business or run a business, you work in a business. You know that you don't have customers or invoices out or whatever level you're at. That doesn't happen every day. But yet in trading, you expect the invoice out, the customer to come in to buy one of every color in every size. You expect it every time. Every trade needs to be a winner. And it's not true. And you know it's not true in the real world of business. People don't come into shops and buy one of every product of every size, of everything on the shelf. So don't expect it in trading. It's a reality check. It's a harsh lesson to learn, but you already know these things. But what's going to keep you sane is those rules that I keep mentioning. So let's get into it in, just a few moments. As I mentioned, for those of you who are new, I'm just a regular guy. I like getting out and about. I've got a crazy thing for flamingos. I don't know why. We've all got something. That's mine. I like going to zoos, long walks, working out, reading books, and generally just enjoying myself. I've been at this for 28 years. I started out very, very young, 15, 16, hand-drawing charts. And I've been full-time at this since 2000. So anyway, point is, I'm not a Wall Street broker. I'm not a financial advisor. I'm not a guru. You should most definitely not listen to anything that I say as financial advice. The only thing that I can do is give you the benefits of my in the trenches experiences on the hard right edge of the charts, having been doing this for so long. I've seen what works and what doesn't work. And I've figured out what works for me. I'm going to try and show you that it can work for you as well. Legally, I can't say that it works, which is a little bit of a shame because we can actually demonstrate it. But nonetheless, past performance, no guarantee of future performance. We're all adults. It's your money. Be responsible, etc., etc. I can show you that the history does tend to sing from the same song sheet. So point is, I've cracked the code. It works. It's repeatable. Easy to replicate. People tell me that it is. It's not just me saying it. I've got lots of lovely people, famous, non-famous, regular folks, just tell me that it's working, which is awesome to see. I get nothing but pleasure when the markets are crashing and the talking heads are losing their minds. And all my lovely traders are quite literally posting the results. Here's the results that I'm getting despite the markets literally shitting the bed and everyone's panicking. So it's wonderful to see. It really just warm the cockles of my heart, the fires of my heart. Anyway, we're going to plug into production line trading. We're going to get to it right now. Thanks for bearing with the slide part of the show. Just 2 or 3 more. I'm going to show you my number 1 moneymaker partner. You're actually going to get a bonus day. You're going to be 2. We're going to be looking at the bear side of it as well as the bull side because there's nothing bullish. There's only bears at the moment and they're growling very loud. So I'll show you how to profit from the downside. This is a part of a larger system. We're going to focus on just a couple of rules to help find trading opportunities, but it is part of a larger system that I call production line trading. And as I mentioned, my aim is to give you the right tools, the rules, the software to assist you. There's a community to support you, and obviously a mentor to show you the right way so that you get real results in the fastest and smartest possible way. And if you do want to work more closely with me, hit reply on any of the emails that you get from me, pop a comment below, shoot me a message, whatever you want to do, let's chat. If it's not right for you, I'm very open to say that. I'll always point you off in the right direction if you're looking for something that's a little bit different. With that said, let's go nerd on the charts. Thank you for the comments in the chat box. Several of you have posted stocks to look at. We'll take a look at those later. Zeke's writing is 100 lines. Very good. Let's do it. So the markets. We've been talking all year about this sell-off. This is not a surprise to anyone. Not a surprise. One of the things that I talk about, just to give you a framework, I use something called moving averages. You may have heard of them. There's nothing magical about the indicators, nothing magical at all. All indicators allow us to do is, and these are moving averages, they're simple. It's 50, 200, and there is another one, there's a 20-period moving average. There is nothing magical about these, nothing magical whatsoever. If we were talking 5 years ago, we would be talking through the lens of Bollinger Bands, because that was what I was using at the time. Nothing magical about Bollinger Bands. I could talk you through exactly the same process with any of the indicators. All the tools allow us to do is give us a mechanical framework to identify what is going on in this crazy world of the markets. So that's all we're going to do. I like using moving averages because they're a little bit easier to codify into an algorithm. I like looking at the general river of money, the institutional footprints. So let's take a look at what that looks like for me. So the first thing I look for is a cross in the average price. Some people might call this a golden cross. And over here on the right, it would be a death cross. Don't roll your eyes at me. I didn't name these things. But all I'm looking for is that 50 and the 200 period moving average to be crossed. And that's just going to give me a directional bias. I'm not married to it in the classical sense. I'm not buying here and selling there. That's really dull and boring. That doesn't actually, looking at some, as I've been reading a lot of studies actually, because people study the crap out of these things. Lots of stuff on the internet. It doesn't actually give you much of an extra edge over buy and hold if you just do moving average cross to moving average cross. It's been shown that while it can provide sustainable long-term trend hold exposure, it's not really adding anything that you can't get from buy and hold. So just keep that in mind. So I'm not married to the crosses in the traditional sense. All I'm using them for is to give me a directional bias. I'm just going to, although I've got 3 moving average, I'm just going to focus on 2 for simplicity for the moment today. I'm looking for a directional bias, essentially. So if the averages are crossed up, I'm looking for a bullish trade. And as over here, if the averages are crossed, I'm looking for a bearish trade. Now you know the secrets. You can be buying the dips very, very merrily as price ebbs and flows back and forth, back and forth. Or what was that? You want to know how to buy the dips? Let's go one level deeper. So all we need to do is identify the direction bias. So what makes a buyable dip? Because what we don't want to do is sit in front of the charts and just randomly pick points on the charts. What we're going to then wait for, now we've got our direction bias, is for price to push away from the averages. Very easy to see, but then more specifically, come back between the averages. And that is going to give me a buyable dip so that when price pushes back away from the averages, I want to participate in that. That's how I'm going to make money. That's it. We're going to wait for that. So if you look closely, I'm just going to circle all the times that price came back to the 50 period moving average. We can do the same thing at the 20, but all the times that price came back to the 50 period moving average and then pushed away. Now, I'm also going to highlight so the algorithm, you can just about see it in the background, plots entries, and there's a little bit of trade management involved. So there are some times where it doesn't work. It's losing money. Again, not every trade's a winner. But what we do know is that on average, as per the rules that I've just mentioned, buy the dip using a buyable dip and sell the rally. Buy the dip, sorry. So buying the dip when price comes below the moving averages or between the moving averages, then that is a buyable dip. And there's lots of times to get involved. Again, the algo's not taking every one of them. It's going to take the first one. It doesn't use compounding, but it means that I can find and recognize buyable dips. And here's the thing. If you don't get that first one, you can take the second one. If you don't get the second one, you can get the third one. If you don't get the third one, you can take the fourth one. If you don't get the fourth one, you can get the fifth, the sixth, the seventh. When you have a trend, there is lots of opportunities to participate. That's what I'm trying to highlight. So if you don't get the first one, or if you're not sure about this early stage trend, or you're not sure about this early stage trend over here, because we're now in a bearish bias, then there's plenty of opportunities to be involved. Get in on the next rally in a downtrend or the next dip in an uptrend. There's plenty of opportunities. So buying dips, find a buyable dip in the context of a trend. Congratulations, you know the secret. You know my number 1 money-making pattern, and this on the bear side is my number 2 money-making pattern. If we just do that, if we add in a little bit of money management, stop loss and targets, slightly more mechanical structure than I've just mentioned. Again, appreciate I've just given you the back of the envelope version. But if we plug those rules into the software and we say, you know what, look back over the last 20 years. If I'd just done that, bought the dip, sold the rally, as per the instructions that I've just mentioned to you, then I've got a positive expectancy. So I'm looking at this as an equity curve. The numbers, I'm not looking at the specifics just for the moment, but just to illustrate, we've got an equity curve that is on the incline. It's quite nice. Again, some periods are making money, some periods are losing money, some periods are making money, some periods are losing money. So just like a stock chart dips and flows, you're going to see that in your equity curve. So not every trade's a winner is what I'm highlighting. But on average, over multiple currencies, you should make a profit. Again, I can't guarantee it, but you should, as per the data. The history suggests that we can do this. Again, it's not complex. There's no curve fitting. I'm not using again, all I'm doing is using a 200 and a 50 period moving average. I'm not trying to over-optimize and use a 27 and 153 period moving average. I'm not I'm not curve fitting is what I'm trying to highlight. I'm very conscious of that. That first guy I worked for did that, and it was his downfall. So I very much know the dangers of over optimization. All I'm doing is taking these standard moving averages that the majority of institutions follow, and then that gives me a clue as to what they're doing. Because if the big money that moves and drives the markets are using these tools, then I want to know what they're looking at so I can jump on their shirt tails. I sometimes describe this as, this is the river of money. This trend is a river of money. And there's plenty of opportunities for us to go paddling in the river. That's what we're trying to do. So when price comes below, or from above to between the averages, there's plenty of opportunities for us to go paddling in that river of money, jump in at a safe, low risk opportunity and go swimming in that river of money. And hopefully we get swept upstream with that river of money. That's what we want to do. That's what an uptrend does. Just the opposite for the downtrend. We've got a brand new early stage trend. This is a bearish river of money. We're looking for rallies to, as our back eddy, the break in the water that allows us to go paddling, get a safe, low risk entry so we can participate in the river of money. We get washed, in this case, downstream with the money. That's what we're looking to do. Again, I'm not smart. I don't know what's going to happen any more than the next person. But all I know is that history leaves clues. And here's the proof. There's the proof right there. I don't know if the next trade's going to work. I just know that on average it does. So that's what I want to do. Just follow the river of money. Right. Any questions on that so far? That's all we're doing. So there's that trade that we were looking at. That I posted my gajillion% return on capital. That was a great trade. Got to admit, I nailed that one. Very pleased with myself. I looked out on the timing, if I'm going to be honest, folks. I'm not going to pretend to say there was anything fancy or clever, but you know the secrets. There's the rally. There's the new downtrend. Sell the rally. The fact that it went so hard and fast, that's the only thing that I didn't know, how fast it was going to move. Usually the bearish moves go a little bit faster than the up moves. So what helped, just to give a little bit of a sidebar, is one of the things that we had noted on this bearish move is that when price pauses for 3 to 5 days, there is often a little bit of a speedy move out. We didn't see this on the bullish side. So just as an odds enhancer, just an observation, it's not necessary to do this, but this is one of the things that we observed in this bearish movement. And that just helped us to refine the entry. Because it didn't quite get to the 50-period moving average, which is fine. So it just helped me to refine that entry right there. And as it was breaking last Thursday, I think it was last Thursday, wasn't it? Then we saw the big down move. So we can see that on the up moves and the down moves. So just a little bit of an enhancement. So we've got the mechanical framework to say the bearish trend is on, sell rallies into the 20 or the 50-period moving average. And you can also look for these little clusters because that does seem to be a nice little additional price action observation where you've got these just little clusters, 3, 4, 5 days, all tightly clustered together. And then you get this little pop to the either the upside or the downside. We're obviously using it in context with the trend. So I'm looking to get bearish. So just an extra enhancement that is more just an observational thing. The way I like to think about discretionary additions, the observational stuff, it's an and. I'm already going to place the trade anyway. I'm already looking to sell the rally in a downtrend anyway. But that little observation that you bring to the table, maybe you're an aficionado in Dow theory or GAN theory, or maybe you've got a speciality with the MACD or an oscillator or insert patterns. I like geometric patterns, price action patterns. That was my thing when I was more discretionary trading. So whatever your thing is, you can layer that on. Find the trade first. And then layer on it's, I'm bearish. And I see this other thing. Okay, cool. It's just going to enhance the flavor of the trade that you're already going to place. Right. With that said, is the bottom in? So you know the secret sauce. Let's look at is the bottom in. We're going to use that observational stuff that we were just talking about, and I'm going to I'm going to take volume off. I don't know why I have volume on. It's just really to pretty the chart up. I honestly don't use volume anymore. I was 12 years a Forex trader. It sounds like a really bad movie. But I was 12 years a Forex trader, and there's no volume in Forex, despite what anyone believes, because it's a cash market, an over-the-counter market specifically. There's literally no volume in Forex. So I got used to trading without volume. I've not really been able to enhance the flavor of the trades. You see low volume breakout, you see low volume trends. You see high volume trends, you see high volume breakouts. There's no rhyme or reason for it. So I don't know why I have it on. Again, it's just to pretty the chart up. Anyway, what I'm going to do is I'm just going to, you can probably do this on most platforms, but we should be able to go insert symbol. And what I'm going to do is I'm going to add the VIX to the chart so that we can see patterns. So the VIX, if you're not familiar with it, I'm going to put it half and half. The VIX is a measure of volatility in relation to the market being the S&P 500. Now, I'm looking at the futures. It doesn't really make much difference, but if you want to be true with it, you can go and put it on the cash market, or the S&P 500 cash if you want to. I don't really care that much to make a change. I like looking at the futures primarily because it trades almost 24 hours a day. It's not quite 24 hours, but it's close enough to be good enough. So I'm just putting that on there for the moment. So what it does, another way of thinking about VIX, is it's a fear index. So when people panic, fear goes up, VIX goes up. When people are complacent, when people are happy about the market specifically, then the VIX goes down. So if I just zoom out to illustrate that point, and again, it's not a chart in the standard sense, it's more of an oscillating thing. So all the way back here, we can see that the VIX was very, very low. So this is 2018. You know, we're coming out of recession, new market highs, the stocks only go up, you know, the usual thing. And it's exceptionally low right there. 2020 crash is right there. And again, you can see that the volatility goes all the way up. So when you've got uptrends, VIX is low. When you've got market crashes, the fear spikes. So that's what we're going to look at. That's what we're going to look at. And it can be an interesting measure of what the market is doing. Because one of the things that we noted, Shuli, you don't need to show the watermark. It does not matter. It does not matter. Pick a chart. It's the S&P 500. Pick SPY, pick an index, pick the cash. It doesn't matter. The chart is a chart. Again, the fact that we're looking at something specific at the moment is irrelevant. So all I'm interested in is, can I make money from it? That's it. Again, I'm completely agnostic to what we're looking at. So we're looking at the S&P 500. Again, the chart doesn't matter. Again, just search it on your platform. So what we're looking for is, again, this is the VIX, this is the S&P, just to satisfy the naysayers. There we go. So what we are looking for is spikes in volatility. So again, I'm going to look. So what I'm trying to figure out now is the bottom in, is the issue, is the bottom in, because the talking heads, the media, they're losing their collective minds. Oh, the bottom's in, it's not, the bottom's in, it's not, the bottom. Every day it's like 180-degree U-turns. And I don't know about you, but like I'm getting whiplash with the media and the talking heads. And if you've not done already, turn it off, because it's the media. Sidebar, the media is representative of the general public. And if the general public is always wrong, why do we want to listen to the media? You know what I mean? Turn it off. But nonetheless, it's sometimes hard to avoid. So we're trying to ask ourselves, is the bottom in? Is the bottom right there? So we can look at, again, granted, this was just a rally in what we know as a downtrend, but you've got this little V-shaped pattern. And we've got price doing the same V-shape. Now, the point is we've got like a double touch. That's what we'll see there. And the number, the reading of VIX, just so you know, is about 35. And that's where we are right now. So if we just carry on going to that 35 level, you've got that same V-shaped pattern, which led to a rally. Interesting. Now, we don't quite have the same thing here. We've got a big spike on this one. So we've got a different shape of the way that it's forming. Now, if you read between the lines, you still have a very tiny V there, which did lead to a small, albeit temporary rally. Can everyone see this? Is everyone seeing? So when we have VIX come up to 35, again, we've got two footprints now. We've got the big spike, like there, or we've got this V shape, a double touch. Now, what price generally always does, despite whether VIX spikes or Vs, is we'll typically get the double bottom. Typically get that double bottom. So is the bottom in? Well, we're at 35. We've got a little bit of a V in volatility, but price is still going down. We've not quite got that V-shaped pattern yet. And again, if we look a little bit more closely, these V bottoms, they can take anywhere from 1 to 3 weeks. Again, you count them anywhere from 1 to 3 weeks. The dotted grid in the background is a month, so that's how I can quickly assess. So anyway, it takes from 1 to 3 weeks, 1 to 3 weeks. So we've got this very short-term observation to say, you know, although the VIX is spiking, and it's at that 35 level, and historically, in the last 6-8 months, when it's got there, volatility has contracted. It's mean reverting, it's contracted. So we've got to presume that it will do the same again. So when volatility contracts, price normally does the opposite. They have an inverse relationship. So we've got to presume that there will be a rally at some point. Now, as I've mentioned, it's only going to be a rally in the context of a downtrend. So it's not that the market bottom is in, but it could be the sell-off low, for want of a better description. Not necessarily a market bottom, but we could certainly be expecting a rally. But is it now? Is it today? Is it going to be this V-shaped recovery or this spike reversal that everyone keeps? No. History tells us that we need this double bottom, very tight double bottom, and it should take about 1 to 3 weeks. And this could be the start of it. This could be the start of it. Again, because price is, for the moment, doing what essentially is an orderly sell-off. It's not crashing. We know what crashes look like. We'll look at them in a moment. They're very different behavior. This is an orderly sell-off. It's painful for a lot of people. We're making money. All the students are making money. So it's not painful for us. But for anyone who doesn't know how to just look at the chart and use a framework, and all we're doing is making an observation. Okay, this is what happened. Again, I'm not trying to thump my chest and say, look how great I am. All I'm doing is saying, this is what happened last time. That spot the difference game that we mentioned earlier. This is what happened last time. Okay, will something similar happen again in the future? Yes. If that is now, because we're at 35, VIX 35, we can expect a little bit of sideways for 1 to 3 weeks before we potentially see a rally in price, a rally in a downtrend. Interesting. Let me just pause there for dramatic effect, which, as you all know, for long-time listeners, is code for any questions while I take a quick drink. Cool. So what we have is an easy way to essentially ignore the talking heads, the media. Good question. So could the rally take us out of a downtrend? It may. I honestly can't say whether it will or it won't. Again, I'm not into predicting the future. It might be the market bottom. This might be the ultimate retracement low. And if the latter part of this year, we go into new market highs. I honestly don't know. I'm not going to blow wind in anyone's sails to say, yeah, this is exactly what's going to happen. I'm not in the prediction business. I'm in the making money business. So all I know is that this sell-off could be the temporary market low. Temporary market low. We're anticipating history to repeat itself. And if history repeats itself, we can expect a market rally as volatility contracts. So if we're going to see a market rally as volatility contracts, that's what we're anticipating. But before that happens, we need to see a little bit of sideways for between 1 and 3 weeks, because that is what history for the moment is suggesting. Now, in this case, you see just the opposite. It didn't rally. It paused and sold off. You still get that volatility. So you had a low volatility sell-off. So you can see that happen. So that's what's telling me that while markets are selling off, volatility doesn't always have to spike. It's just that fear. Usually it's associated with speed of movement. So this caused volatility to spike simply because of the speed of movement. So we've got quite an orderly sell-off is what this is observing. So I don't think we're going to see a crash. Crashes happen once every 10 years. We've just had a crash. We might see a flash. I'm going to say the word crash again, but not in the same sense, which recovers quite quickly. We can go and look at a couple of those in just a fact. Let's look at them right now. 2018. Again, we're just looking at the last 6 months, but we can look at the same thing. So there's 35 on the VIX. So generally when VIX goes above 35, that's when we start to get into crash territory. 35, certainly when we go over 40, again, 40 is just there for reference. So VIX 40, generally we're into crash territory. When we're below 35, 40, we're generally in a correction mode. Let me just scroll back. So let's get so we're now looking at 2000. Let's look at 2018, 2019. So why are we doing this? Why are we doing this? Because we're trying to evaluate bottoms. I love looking at bottoms. Ooh, Vicar. If you're going to get some mileage out of a joke, you might as well continue saying it. So we got, again, for most people, that was a crash. So again, this is 2018 for reference. There is 2019. Yeah, absolutely, Glenn. Yeah, history repeats itself. This is why we're doing it. History repeats itself. So we don't need to listen to the pointers. We don't need to listen to the talking heads. We just need to go and make some observations. We can find footprints and clues in anything. And again, we're using moving averages. We've got a structure to recognize market trends and direction. What we've just laid into is the VIX, VIX, which is a volatility index. It's basically got an inverse relationship with the S&P 500, which is why we're looking at both these two together. We can't do it with Apple, for example. Anyway, but we're looking for these V-shaped bottoms. I can't say it without chuckling. I'm such a sniggering schoolboy. So exceptions to every rule. So here's your exception, Glenn. Will it be a V-shaped recovery? They do happen, but they don't happen often where you get that spike in VIX, and it's that not a double bottom. It's very clearly what's the best way? Spike recovery. I'm reluctant to say V-shaped recovery because we've used V-shape to describe the double bottom. So I'm trying to avoid a little bit of confusion. I think I've just failed. But we've got a very different bottom there. We can see the VIX, in this case, 25. VIX there, do that double top, that's double top there. We don't need the double top in the sell-off. So there's price making new lows, but VIX here didn't make a new high. If VIX was making a new high here, a lot of people would be perhaps thinking crash, which it didn't. So VIX can be a good indication as to whether we should panic as traders, whether we should be thinking about hedges if you're thinking about such things, whether you should think about tightening stops, tidying the portfolio up, however you want to phrase it. So should we panic over this? Should we panic over this sell-off? Might be a question. Is the bottom in? Well, yes, it's continuing to go down, but VIX is staying relatively stable. Okay, cool. So that's important to know. That helps us to not panic. Just like over here, big sell-off, price still above the 200 period moving average, which is right there. Big spike in volatility, mainly due to the speed of movement. Price comes back to the lows. VIX is nowhere near that previous relative high. So it was fast. It was painful. There was a couple of years where the markets, as you may remember, markets only went up for a period of 10 years. But when these corrective moves happen, we can evaluate them sensibly without panicking like most of the media would have us do. So we've got the price selling off, VIX stays There's that double top. Okay, so yes, it's making a new low, but should we panic? Is the bottom in? Well, I don't think there's anything to panic over. Similarly here, if you weren't already out the market, price recovered. Should we panic? Again, we didn't really get above 35. So yes, it's painful, but we're not quite into crash territory. And there's your exception to the rule, Glenn, where there is a very speedy recovery. So coming back to your question, this is our footprints. This is our footprints for will there be an immediate recovery? Does that make sense? That's why I eventually got there, Glenn. I eventually got there. That's our footprints for your question. Will the market recover, and are we going to start to see the resumption of a bullish trend? Well, does this bit of the charts look like the live part of the chart? So let's take a mental image, take a pretty little picture in your mind of that part of the chart. Does this look like the live part of the chart? Kind of. We've got the market selling off. Looks like more, again, the average prices are crossed over. We've got leisurely downtrend. We've got price at 35. We've not really seen the markets, while the market's selling off, VIX is staying firmly at 35. This is looking like a very orderly downtrend by comparison. It's looking like an orderly downtrend by comparison. Why? Although we've seen a fast move, which could have panicked everyone, VIX didn't spike to the moon. So that's the differentiator. VIX didn't spike. Yes, there was a fast sell-off. It wasn't a huge sell-off in relation to the previous part of the chart, but the big differentiator is VIX didn't spike beyond 40. So while it's painful for a lot of people, the market's not crashing. This is an orderly, for the moment, still an orderly bear movement, a sell-off, what about description. Let me pause there. Can everyone see that distinction? Price behavior looks similar, but the differentiator is the VIX. So is the bottom in? Well, the sell-off might be over, but only in the context of price is probably going to rally for the next downtrend. It's not looking like the bottom is in for the moment. Yeah, good. Another good observation, Glenn, as well, yeah. It doesn't mean a crash can't happen. Just want to reinforce that. Yeah, you can't really analyze VIX in the same way as you would a stock chart. So yes, while it does have higher lows, and you can on this occasion draw trend lines. I actually went through the last 20 years. That doesn't happen that often. Yeah, it doesn't happen that often. It's not something you can chart in the traditional way. So we've got interesting observations. Right, let me just catch up on some of the comments. I see you all chatting there. Let me just quickly catch up. If you've got any questions on this before we move on, we're going to look at some individual stocks that you've all posted and just run them through the algo to see if it's worth trading. So history repeats itself. That's absolutely right. Mark, as long as the Fed continues to raise interest rates, we can expect that downtrend to continue. That's absolutely spot on. And we knew it was happening. It's not like this should be a surprise to anyone. You know, the interest rates are going up, not just in the US, but globally. Europe's just hiked theirs as well, globally, internationally. You know, it's the stem inflation. All right, they're doing too little too late around the world. Inflation's going a little bit loose and crazy, but it's going to happen. You know, it's been well announced that it would happen. So bear market is going to be a short-term pain thing, but it's going to be healthy, slow, steady eddy. Correct. No one wants a crash for sure. We know what happens with crashes. We've just been through one. But a steady, healthy bear market is a good thing for the economy. Raging crash, bad. Healthy, slow, steady bear market, good. So the VIX on high. Fed's been raising rates in ordinary money. Yep. Just catch up with the comments. Bear with me. Chart on the VIX. Brett, sorry, just caught up with your comments. I think I answered that as well. You can't actually charts the VIX in the same way as you would do a stock chart. It doesn't behave in the same way. It's essentially an oscillating range. Usually, under normal circumstances, it'll stay between 15 at the low end, and it'll, with retracements in as you can see here, with retracements in a trend, it'll fluctuate up to about 25. It's relative, so you've got to measure it against itself over the most recent history. So now that the bear market is selling off, that range is now jumped from 20 to 35. Now, when we looked back at it at 2 years, it was more at that 25 range because, for previous 3, 4, 5 years, markets have been trending. And we're just seeing a different range of volatility. So just keep an eye on mind. You just need to look back again, last 6 months, just eyeball it is all we need to do. What's the range? Okay, the upper boundary on these sell-offs is 35. And the lower boundary is about 20. So, when it gets down to 20, we've got complacency. When we're up at 35, we've got the fears at max. And when it's certainly above 40, which is the general rule of thumb with crashes, if it's above 40, we're probably crashing. And it's too late to do anything at that point. You might as well just sit through it. If you've not done anything before then, you might as well just sit through it. And the institutional profit taking, it probably happens. That's what consolidations are. That's what consolidations at the end of trends are. So a good observation, is this profit taking? No, they're positioning themselves to the bear side. Institutional, let me just get the, where, you know what? I don't use it, but I like it on. Sometimes there's a clue with a volume spike. Bear with me. So could it be institutional stuff? It's a little bit easier to see on the Dow. What you will see is basically high base consolidation. So let me just zoom out. So we knew at the end of last year, and again, I know you've been following the chart. So when we've looked at the market in relation to the Dow, when we have, again, usually when we have at least 3 crosses in our average price, that's when we're starting to say the market is range bound. So the 20 and the 50 is what I was just talking about. The 20 and the 50 period moving average, this is the Dow futures. 20 and the 50 period moving average cross at least 3 times. I've got to call it a consolidation. So you get this high base consolidation here. Previously, there was a trend. When there is consolidation, one of 2 things has happened. It's either accumulation or distribution. So you'll get this rally, you'll get this consolidation. And if that trend's going to continue, you'll get the next leg of the movements. And that's normally what happens. You get these consolidations in price. At the end of trends, the opposite happens. You don't get the breakout to the upside. You start to get false breakouts, which is what we saw here. We were talking about this in real time. We got false breakouts. We've got a new high, another false breakout. We've got multiple false breakouts, as you recall, on when we were talking about this in real time. But nonetheless, at that point, we're talking about consolidation. So the base of that consolidation was challenged. The high didn't get breached. You got this lower high inside the consolidation, and there is the direction change. You've already got your average price crossover, but just looking at it in the context of a consolidation from it, you got this base low. So there's your breakout, there's your pullback. It should be no surprise that price is moving down because we've been monitoring this for 8 months. Talking about this for a long, long time. Let's go back to the S&P. It's not as obvious, but we did start to draw our lines in the sand. So we've got that long uptrend. So talking about it with a little bit of hindsight, obviously, but we did talk about this in real time. So we had this more rising channel consolidation. 1, 2, 3 crosses on average price in a very short space of time. The usual thing. If you want to draw it horizontally, you've got 1, 2, 3 right there. Whatever happens, you've got your consolidation somewhere around there. That same place on the chart where you've got the multiple crosses without really any difference in the crossover price level. Again, it's not trending at that point. The S&P, the Dow is already sideways. The Russell's been sideways for a year. You see the same things everywhere. So you get this trend into a consolidation, a base, if you like. And that's what they're running up, trending down, false breakouts, false on both sides of the moves. Is what's happened. It's usually an accumulation and a distribution is usually how it's referred to. A little bit easier to see on the Nasdaq. Let's take a look at the same thing. My apologies, on the Dow. Let's take a look on the Russell. You'll see the same thing on the Russell. You've got this consolidation. Again, we were already speaking about this. That same consolidation. You see the past analysis. You've got the big trend up, multiple crosses in the average price. That's when we started to say, you know what, the Russell is consolidating. It is contained between an upper and a lower boundary. False breakouts. If you remember, we got really excited when that happens, saying, oh my God, it's looking at breaking to new highs. It's going to be great. And then it pretty much turned around as soon as it happened. False breakout gets all the retail traders in. That's institutionals unloading. That's what it looks like. That's what a false breakout is. It's institutionals unloading their position. Then you get that same thing on the other side. The consolidations are where it happens essentially, but you've got this trend into consolidations, and then the potential direction can change. It can obviously lead into a new direction, but that's what the contractions and expansions are in price. It's basically them filling their boots up, for want of a better description. I'm not really sure I articulated that the right way. It is a discretionary analysis to make these observations. I like a little bit more structure, but that's usually how you would identify it. Really clear on the Russell. You can see it on the Dow, not so obvious on the S&P, but nonetheless, you can see those footprints, expansions, contractions. You'll see it all the time on, again, you can go and look at Netflix as well, NFLX. You'll see the same thing there, where you have that multi-week, multi-month. There we go. You got that, trend, 1, 2, 3 crosses in the 20 and the 50s. At that point, you've got to call it a range. That range lasted for many, many months. Just draw a big box around it. Again, I'm not clever or fancy. Just draw a big box around it. We just traded the breakouts. We got it quite good. When it comes back into that consolidation, it's fair to say that price is failing to continue. So there was some initial buying, I would say, there, but something's obviously going on. Obviously, we know what happens. There was forecasts about their earnings, etc., and subscription rates and all that jazz. But when it goes through the bottom of that prior base, you've got to be bearish at that point. Again, that's that footprint that you were describing. So it is there if you're looking for it. Again, I don't usually trade in that same context of looking for institutional footprint, but that's what it can look like, if that helps. For me personally, it's not really critical to worry about. Let's put our framework to the same thing without having to do discretionary analysis and do the coulda, woulda, shoulda. Is it institutional? Let's take the mechanical approach. Average price crossed over. 50 is below the 200. I've got to be bearish at that point. I'm looking to sell rallies into the downtrend. Price comes back to the 50-period moving average. You've got to be bearish. The algo's fired off. It's gone back above the 20. You've got a new selling opportunity right there. If it comes back to the 50, you'll have another selling opportunity there. It's sell the rally in a downtrend. So I don't need to worry about, is it institutional? Is it not institutional? The direction, the price, the footprint, the mechanical assessment mostly takes care of all these coulda, woulda, shoulda interpretations. VXX, sorry, Brett's catching up with your comments. VXX is the ETF of VIX. And again, I would come back to it's probably not worth trading in the same way. It's trying to trade or trying to chart volatility in the classical way is a fool's errand. It's not impossible, but the trade-off is time at screen, time invested. It's more discretionary in its interpretation, which does seem to be the flavor of this week's open house. But that's the trade-off. It's time. So I'd rather have a mechanical assessment. Again, all I'm using it for is, for example, should I panic over continued downward movements in the S&P 500? So, should I panic? I can, let's just take a quick look at the VIX. The VIX is at 35. Again, I've got those lines marked off that I mentioned. VIX is at 35. It's finding those boundaries there. Okay. While the stock market is selling off again, it's not going past 35, so I don't need to panic about a crash just yet. Maybe I should take some money off the table on the bear side, lighten up the portfolio, take some profits if I'm close to targets. That's how I would read that, because I'm expecting a rally in a downtrend where I can load up on new entry setups as per the algo rules that I've already described. Oh, cool. Thanks for the thanks for being my number one listener, Brett, on the podcast. Right, so let me go back to the beginning. Let's take a look. So Anthony was asking about crude oil. How crude? Crude oil. So in fairness, Anthony, now that you know the secrets, you tell me, buy the dip or sell the rally? Open question. What do you want to do on this? Would you want to buy the dip or sell the rally on crude oil? So would you want to buy the dip or sell the rally? Buy the dip. Perfect. Yeah. So now you know the rules, you've got the structure. So it's clear visually, it's clearly going up. Great. There's the 200, there's the 50. Again, let's just stay with the 2 moving averages for the moment. We can use 3, but just stay with the 2. In fact, no, let's use 3 actually. So you've got the 50 and the other one is the 20 right there. So there's the 50, there's the 200, there's the 20. So right now price is moving away. So there's your profit opportunity previously. So right now price is dipping below the 20. Cool. So when it pushes back away, there's your buyable dip. So it's not just buy the dip. This is a buyable dip as per mechanical rules. It's touched the first condition. If you want to wait for a deeper retracement, wait for it to come back to the 50, that would also qualify as a buyable dip. And you're looking to profit as it pushes away. Again, similar to over here. So retraces, the algo fires off. You're looking to profit on that bit. You get another trade, doesn't make any money. Just going to point out the obvious. The algo would have lost you a little bit of money. Small loss, big profits. So it comes back still below. When it goes back above the 50, gets you back in. This one hit targets. Again, I profited on this, as you all know, with individual stocks in the sector. I didn't trade oil directly. I just prefer to trade stocks rather than futures, personal preference. But again, multiple stocks in the sector benefited from that move. VLO being the most notable one. That was my 1,000%er. Lovely. But nonetheless, you've got a little bit of consolidation. So there's that accumulation that we were talking about. We know only that it's accumulation afterwards. If it was distribution, we would have seen a sell-off. We only know that afterwards. So it's broken out. The algo is suggesting upwards. Our trend bias is bullish, but nonetheless, all these are buyable dips in the context of a trend on crude oil futures. You can also trade this on USO, United States Oil, which is the ETF. It's a little bit more of a smoother ride. The futures you're trading often the near expiration month or the most active near expiration. You can see exactly the same footprint, exactly the same pattern on USO. I do trade USO. I don't which is essentially crude oil futures. I just prefer to trade with stock options. And all this is an ETF. It effectively trades and behaves like a stock. The algo that I use is fired off a trade right there. You can see it plots all the deets for me. And we should be looking at a target of $160. Oh, there we go. So on USO, it's about 105. But yeah, it's autumn. So on the futures, that'll be $160. Should be a little bit higher on this, but there we go. That's what the algo says. Don't second guess it, Phil. Stop judging. But there we go. There's the algo's just firing it off. So just waiting for that to get to targets. So a couple of ways of trading it. You can trade it with energy stocks, which is what I like to do. I'm basically smashing the whole sector with individual stocks. You can trade it on USO. You can trade the futures if you'd rather trade futures. Bonds. Someone was asking about bonds. Does it work on bonds? Let's take a look at the 10 years. I think just waiting for that to load. I actually posted something about this about 14 days ago. If you're following me on my emails, the average price has crossed over. You've got a little bit of a consolidation there. Breaks down, rally, sells off, rally. And this is where I posted up on the socials and then sells off. So sell a rally in a downtrend. You know, it's a really simple concept to grasp. It's not just buy the dip. It's not just sell the rally. It's find a sellable rally in a downtrend. Find a buyable dip in an uptrend. You've got the structure that I use. When it gets back to our classic average prices, sell the rally. When it gets back to the average prices, sell the rally. You don't have to draw trend lines on. You don't have to do the extra stuff. You don't have to draw down 3, GAN 3, LOA 3. You don't have to be in a Aficionado. You've got this structure. Those moving averages are automatically drawn. So just put them on your charts, use a simple framework, and just farm the setups. You don't need to go hunting, just farm them. Just wait, pick a chart, start with one. Look at the oil, look at the Dow, look at the S&P, look at anything that makes sense, that's proven, that works. Apple's are favorites. Put Apple on the chart if you want. So Apple's just gone into a new bearish direction. We've got a lovely consolidation. We've had a lovely uptrend for several years, in fact. Average prices have just crossed over. Guess what we're going to be doing? Selling rallies in an early stage downtrend. I don't know how long that trend's going to last. Honestly, I've got no idea. I just know that on average, the data tells me that it works on average over multiple currencies. Right. I think I've caught up with most of the comments and the questions. Let me just double check. Okay, Randall, thank you very much. Hop off. Vic's comments, got them. Institutional profit taking. Could be accumulation or distribution. I don't know if it's profit taking or loss taking. I don't know what their balance sheet is, Glenn. It's usually referred to as accumulation or distribution. Buy the dip, we've already got that. Awesome. So question from Anthony. If it goes below the 20 period moving average and then the 50, I'll answer that privately. It's a little bit more beyond the time because I'm already a little bit over time, Anthony. We've actually got, let me try using English rather than that mouthful of gibberish that I tried to spell. You've got access in the members area. Go and review the training. Go and look at the first video. That'll summarize the question that you're asking there with the members training. So if you just log in, it's the first video in the members area, and you'll be able to get that question very easily. Again, it's a little bit more than the time that I've got left to answer that question. Right, let's do it. Guys, girls, ladies, gents, old folks, young folks. Ooh, never manage losses. Where's my slides? Where's my slides? Right, there they are. Right. Thank you, as always, for your time, for your attention. It really is appreciated. I can't find my slide. There it is. There it is. There we go. That's what I was looking for. I should put it further up. As always, thank you for your time, for your attention. It sounds like I'm saying the same thing every week because I am. I'm not trying to dazzle you with anything new and shiny and sexy. The reality is what works is boring because and I refer to what I do as a production line. I refer to what I do as a production line for a reason, because it's a production line. And unfortunately, production lines are boring. You're doing the same thing every day, waiting for things to happen, putting the pieces of a puzzle together using a rule-based system. So it does work. You just need to have faith in it. Again, if you've been watching me for any length of time, I've been doing these open sessions every Friday now for 2 or 3 years. I've been doing them infrequently for about 15, but nonetheless, I've been committed to doing them regularly because I got sick and tired of people saying, oh, if you're so good, why didn't you do it for free? Ta-da! Like magic, we're here. You've got the secrets. All that I would hope and wish for each and every one of you would be to go and do it. That's all you need to do is go and to do it. If you would like to work more closely with me, again, I'm not shy of saying it. You can work more closely with me. I don't work with everyone. It's by application only. My aim is to give you the right tools, the rules, the software to assist your community, to support you. I'm liking this. I wrote this morning. I'm very pleased with how it rolls off the tongue. Obviously, a mentor to show you the right way so that you get real results in the fastest and smartest possible way. You don't have to take my word for it. Many people have been before you if you're thinking about it. I'm sure there'll be many people after you when you finally decide to take the plunge. What I've shown you today is just a very small part of the entire process. We have 6 money-making patterns, and obviously the support, the software, the tools, and all the rules, the specifics of how to do what we do so that you can do it in just 20 minutes a day is available. There's what the software looks like. We've got some of the algo. You've seen some of it in motion today, but we get to validate every stock, every trade. Should I trade this? Well, the history suggests that it looks good. There's my entry, there's my stop loss, there's my targets. Voila. It should be a simple process to follow. So with that said, once again, thank you for your time. Thank you for your attention. Fully appreciate that we could all be doing something else with our day. I'm very thankful that you decided to spend some of it here with me today. If you've got questions, comments, observations that I've not got to or I've just simply overlooked, please feel free to send me a message. I am very active in my Slack community. If you scroll down to the bottom of any of the emails that you receive from me, you'll see a link to join the community. You can come and join the general area. If you want to have a chat, you can just click my name and get to me anytime you want. There are private member communities. If you're not already in the private member, if you are a member, just send me a message and I'll add you in there. We have an active community if you'd like to join us. With that said, I think it's time to, what should we do today? It's time to land the plane, folks. Again, thank you for your time and attention. I'll be back to my usual schedule doing these every Friday. This has been recorded. It will be processed and uploaded in the next hour. If you want to rewatch it and take any notes, you're more than welcome to. You should be notified via email as soon as it's ready. But with that said, I think it's time to land the plane. Have a great weekend, folks. See you all same time next week. Whatever you're doing, make sure that you do have some fun involved. I've got parties planned. I've got ice cream in my immediate future. Whatever you're up to, make sure that you have a good time. Otherwise, what's the point of doing all the things that we do? See you at the same time, same place next week, folks. Bye for now.